I might be slight delay. Let me see if that's caught up. Okay, we'll work through it. Thanks, everyone. I have with me Diogo Mónica, founder and leader of Anchorage. Really a pleasure to have a chance to moderate and discuss with Diogo. Diogo is one of the leading thinkers, blew me away when Block Tower was exploring custody as just incredibly smart, thoughtful on every angle of crypto custody. So a pleasure for me to have the chance to pick his brain a little bit and that we can all get some of Diogo's wisdom on the current state of regulation of custody and how the world's going to evolve. So thank you, Diogo, for joining us.
Thank you so much, Ari. I appreciate the niceties.
Well, let's dive in. And I'm very much here to kind of just provide prompted questions. So feel free to monologue at length. And as unlikely as it is, if you actually run out of things, I will find more harder questions for you. But why don't we just start with a brief introduction to Anchorage?
Yeah, absolutely. Sounds good. I think, hi everyone, my name is Diogo Mónica, co-founder and president of Anchorage. I think at a high level, the best way to describe Anchorage Digital is as an institutional platform that provides the services and the infrastructure that institutions need to securely custody, trade, lend, borrow, and really participate in any blockchain activities and build products in crypto. And also something that is relevant, in January 2021, just this year, Anchorage became the first company to be granted a federal banking charter. And so now in the United States, we are regulated on the same footing as all the other national banks, such as BNY Mellon and some of the other large banks. So that was great for the space and obviously great for Anchorage.
How long did that banking charter take to achieve from when you guys first, let's say when you first started the application process, because even submitting an application takes a long time. So like start to finish, how long did that take to achieve roughly?
It's hard to answer because the way that we actually got the charter was instead of doing a de novo charter, we actually did a charter conversion from our South Dakota Trust Charter into an actual national bank and national charter. And the reason why that was faster is because we already had a proven track record in market. We had been in the space for almost 4 years. We had hundreds of clients. We had proven architecture, moved tens of billions of dollars on chain assets. And so when the OCC and Brian Brooks, which was at the time the controller of the OCC, we started talking, it became obvious that was going to be a lot faster because we already had most of the policies and the procedures and the technology, and we were already a regulated entity that already had clients and track record to show how we were doing things. So we did not do a de novo charter, which was really interesting. And so for that, what I have to say is because we were not a de novo charter, the process was a lot faster than it traditionally would be. And so it actually was end to end about 4 months end to end, which is absolutely amazing when you're thinking about that this is actually a trust charter. This is a bank charter, and a bank charter to take 4 months was because obviously we were already operating, already had a track record, but still incredibly impressive. And I do have to say that our interaction collaboration with the OCC has been incredibly fruitful. They're very engaged in crypto. They're very forward thinkers. And so that was actually an excellent experience.
Gotcha. I feel like you're understating the difficulty because I remember from getting the trust charter, so maybe wrapping that in. But my leading point of the question was it's a multi-year process to actually get to that end result, right? And as you know, which no one else has achieved. So I feel like you're understating the amount of work you guys put into kind of that full path. Let's dive into the regulatory landscape, which I think is kind of on everyone's mind today, but of course is always on your mind given that it's such a regulation-focused business line that you're in. So I'll start as an open-ended question. What should people know about the regulatory landscape, particularly as it affects custody today?
So there's a lot of moving pieces. I think even just this week, when Gensler actually released some of his notes, and we have seen some position papers on stable coins, and there's definitely a little bit more of a focus on the regulatory clarity around crypto assets. And it's always like this. It comes and goes. So there's many things to say. First, let's start with the very positive end of the spectrum. Last year, and this is related to what we just talked about, and you're absolutely right that I described this process of getting a national charter to a national bank in an easy manner, but it obviously took years and years and years of constructing policy and procedures and working technology and answering the legal requests and really showcasing what we had built to be actually considered to be at the high water mark, which is what a federal charter is. So last year, the OCC, which is the Office of the Controller of the Currency, so it is the Bureau of the United States Department of Treasury that's actually responsible for overseeing these banks. They issued a number of statements that were clarifying the roles that banks can play in digital asset ecosystem and in blockchains in general. So focusing on the positive, there were three main things that I want to point out. Number one, that they made clear that banks can custody digital assets and provide banking services to legally operated companies in the crypto space. So that's incredibly important. It might sound obvious in hindsight, but it is not clear at that time before this came out. And so clarifying statement there. They also made clear that banks can participate in decentralized networks and use stable coins as settlement infrastructure. So that's also incredibly important. And then earlier this year, when we got the charter, finally, we got to be granted a charter that met the guidelines that the OCC had released last year. And so it's incredibly important to understand that this high watermark of the federal charter was just not available because people were not being able to meet this before the clarity came. And now that the charter is, people can look back and understand exactly what is happening in the space and what we can and what we can't do in the regulatory scrutiny that Anchorage is subject to because we're a bank. And so in terms of the rest of the regulatory landscape, I do think that will always be a back and forth. And it is very obvious to me that the things that have been happening with meme coins and to a certain extent meme stocks themselves are actually bringing scrutiny and they're bringing scrutiny in a way that whose answer might be a little bit going too far off onto the other side. And so in a way, I think that the concern is very valid. We need to protect consumers. And Anchorage, I will remind you that we focus on institutions. So we're here to help institutions build products. So we're not supporting these types of meme coins and we're not out there to publicizing to consumers because we don't do retail. But I definitely have seen that the focus and the rise and fall and having Elon having such an impact on social media to be able to move candidly any stock and any coin. This is not a cryptocurrency problem. This is a social media power law distribution problem. But the fact that it's being seen as a cryptocurrency problem, it is not good for the space. And it's inviting scrutiny that is taking an angle that I don't think is the right angle for us to look here. And so there's a lot of things happening. There's a lot of things always happening in crypto and crypto regulation. We've had so many good news over the past few years. What we can't expect is for everything to be done neatly tied in a bow tie all of a sudden. And I think specifically to the topic of this conference, DeFi, I have to remind people that we're still getting the basics right. We're still getting the basic frameworks right. We're still getting what is a stable coin, how is a stable coin treated, talking about different types of assets, whether they're securities or not securities, the decentralized exchanges and the decentralized insurances and what is happening with the lending ecosystem. A lot of those things are still a little bit too much further than what the regulators have actually gone to and became comfortable with. So we need time, we need patience, and we need to continue to do this work, which is education. Always showcasing what is happening, what is the valuable technology and the valuable use cases behind it, and why we want it to happen in the United States and not outside.
Got it. That last point allows for sets up a nice follow-up question. So from my seat, the U.S. regulation and regulatory landscape, even the things that have been threatening, have been very mild. So like the Newsom Treasury proposal, from my perspective, was actually not that big of a deal in the sense it was basically just applying existing AML KYC rules, which we may not like. I'm not saying I necessarily love that as someone who definitely shares some cypherpunk sensibilities, but I don't think that would have been terribly harmful to crypto. I think something like that is very likely to play out in a world where crypto is very successful. But you mentioned U.S. versus Europe, and I front and center in the headlines are the European kind of drafts of regulation that would affect stablecoins. Wondering if you have thoughts on that, how that could impact Anchor Labs and the custody business, and just any general thoughts on upcoming European regulation, particularly on stablecoins?
So there's a lot of moving parts. I don't think I have a final opinion on how things are going to go. I usually say I hate making predictions because I hate being wrong. However, there's very clear focus on it because the use case is so obvious and the use case has been growing. It is one of the biggest successes in crypto is really the stablecoin use case. And the fact that when we allow people to have fast iteration and to create products that use, in this case, stable coins, but stable coins pegged to dollars. So they use dollars at the end of the day to create products. They innovate 100 times faster than if they have to actually go through the traditional financial system and to actually deal with the gatekeepers. And so it's very clear that it's a massively, very fast growing use case. And the popularity of it is the reason why we're seeing all this scrutiny, of course. I will point out that from a regulatory perspective, I think there's just been a position paper that came out talking about it. I do have to say that we have regulatory clarity on how to deal with these assets. We have federal banks in the United States, in this case, Anchorage Digital Bank, that can do custody for these assets that are meeting the highest regulatory scrutiny. And I will remind you that stablecoins, by and large, and that could be something that we do, are one-to-one backed. We are not running fractional reserves. The risk is absolutely minimal. There's no run on the bank if what you're backing is one-to-one dollars on a stablecoin. So a lot of these concerns are a little bit misguided just because people don't quite understand how these things are being done. And frameworks and the ability of displaying, like if a stablecoin is one-to-one backed or if a stablecoin follows this type, then it is okay for it to exist in the system. That might be the right direction for this regulation. But now treating it as if it is a systemic risk to the US dollar or to the euro, not understanding that stable coins are in fact in DeFi making Tether and TUSD and USDC the most popular stable coins that are being used in this new ecosystem. And so they're actually expanding the reach of the dollar and expanding the power of the US economic might. And so the same capital controls that we have on the US dollar, they extend to stable coins that are backed by dollars by definition. And thus we're actually having more power in the ecosystem as the United States. And so it sometimes feels to me a little bit misguided, this kind of over focus on how this is a systemic risk, because how they're built, it is not a systemic risk. And number two, it is not fighting against the power of the US dollar, it is in fact spreading it and amplifying it. So that's what I would say is two of the things that every time I hear an argument otherwise, it is a little bit frustrating, for me.
Got it. Let's shift back to kind of the focus on custody. How's crypto custody evolving, and in the context of different types of customers and potential customers? So you've got, I imagine your customer base has evolved pretty dramatically over your existence, probably from more crypto native institutions to probably, I'm assuming, more institutional. Would love to hear, how do you think about those different types of customers, their different needs, and how that's evolving over time?
So Anchorage was started in 2017, and 4 years ago, it was very, very clear that our client base that was on the bleeding edge of investing in crypto assets, and this, because you were very much one of them. People were investing in crypto, and those were the crypto funds, the VC firms, the hedge funds that were really on the bleeding edge. Those were the types of institutions that were around in 2017, really. And the market has dramatically changed since then. It has changed in general in terms of participation. We've seen these large public traded companies taking positions off of their balance sheet. We've seen these large corporates like Visa announcing specific crypto asset, settlements instruments, and so specific stablecoin and crypto asset partnerships. We've seen many institutions, large and small, participating here. So it's a very different world. And for Anchorage specifically, something that we've seen was that 3 years ago, every single bulge bracket bank or even large fintech was coming to Anchorage and asking us what they should be doing in crypto. That was the conversation. It was like, I love this crypto thing. You are the experts. Tell me what to do. Today, that has shifted dramatically 180 degrees. They are coming to us with use cases that I hadn't even thought of. And part of the reason why I hadn't thought of is because people are looking at their core business and looking for ways that crypto can make it more efficient. And I'm seeing this particularly in fintechs, where they're actually looking at their core business and looking, how can I replace this particular portion? How can I make these disbursements of payments more effective? And they're looking at stable coins, and they're looking at blockchains and saying, hey, actually, these two things make my core a lot faster, make it a lot better in terms of distribution, a lot better for our clients, and cheaper at the end of the day. So that's something that is happening. At the same time that for the bulge bracket banks, they were also coming in and, with this sense of, we want to do something in crypto, undecided as to what. And now they're coming in and they're using our collateral administration system to offer loans to their clients. They are using our platform to provide sub-custody for their actually ultra high net worth individuals so that they don't lose those relationships of the clients that already have that want crypto. They are coming in and their treasuries are talking to us because they're very interested on how they can use crypto opportunities to generate 7 to 9% yield on their US dollars on a yearly basis, instead of having it on a traditional bank account, generating 0 to 0.5 on a money market. So all of those things have changed dramatically. The major difference is very large institutions were asking us what to do in 2017 and 2018. And now they're coming in and saying, this is what I want to do, Anchorage. Can you help me? Which portions of your platform should I use to build A, B, and C? And then we can dive deeper into the more edgy use cases and the really cool things that are happening, specifically into like the rise of fiatless banks or crypto rewards or, payments infrastructure and settlements that are being done in stable coins. There's all of these really cool things that are happening at the institutional level that just weren't even on the roadmap or really a possibility because these institutions didn't exist in 2017.
What's this is kind of an open-ended question. What's the current biggest pain point to serving those incoming institutions? It's open-ended in that, kind of any way you want to take that question. What is it? Is it kind of getting through their bureaucracy and they just need to be educated internally and they need so many senior decision makers? Is it a product issue? Is it a piece of a stack you guys still need to build or is missing in the industry? Or is it seamless and we're just progressing?
So I wouldn't say that managing and integrating with very large partnerships is ever seamless. I will point that out. However, what I'll point out is that the major blockers at this point, there's no systemic blockers. People talked about how liquidity and lack of liquidity was a blocker. That's really no longer a blocker, definitely for the biggest assets in the top 10. People talked about how regulation for custody and clear guidance on qualified custody was a blocker. Clearly not a blocker when, entities like Anchorage Digital Bank are clearly qualified custody and qualified custodians in an unambiguous manner. There were issues around just how do you do compliance? How do you do AML? How do you onboard this? What are the levels? Also figure it out. Now, the major issues that I see are that a lot of these companies still are making their decisions as decision by committee and decision by consensus. And what happens is that when you have decision by committee and consensus, one person saying no effectively kills the whole process or makes it go 10 times slower. And crypto still has this, barbell approach in terms of camps where some people are incredibly against it and some people are incredibly pro, and there's very little in between. And there's still a lot of thought process around, is this a risk for my traditional business? Which has been actually interesting because one of the reasons why these very large institutions want to use our federal charter to provide these services and do sub-custody is exactly because they know, especially for the bulge bracket banks, that they have to serve their clients using this type of charter, but they don't want to use their own charter for crypto. They don't want to have any kind of issue around Bitcoin or Ethereum or any kind of crypto asset participation somehow coming back and affecting their primary charter. So that's actually been a very interesting benefit of having this type of regulatory charter, that it wasn't obvious from the onset. Some of these large companies are looking at these solutions and saying, do I build it myself? Do I get external technology? And then even if they do number one or number two, they end up realizing that, with which charter do I do this? Is it a trust charter? They have to go down this path, and then they end up concluding that actually they don't want to create a new bank. And so they kind of like come to a solution like this that actually allows us to have all the technology and all of the regulatory elements in the United States figured out, of course. It's
an interesting point, the need to delegate, not just the, I think probably obvious to many, the operational side, which takes so long to get up to speed and gain conviction in. I mean, thinking about a TradFi bank trying to recreate what you guys have done on, well, I was going to throw out a technical element, but I don't even know what you guys still consider proprietary, but just the level of thought that goes into the hardware, the software, the operational side. I mean, there's so much there, but interesting to hear that the value of also delegating the regulatory side, which is not surprising, but not an angle I had really thought about. Let's shift to other value-add services. So Anchorage, you guys have kind of gradually been adding services on top of basic custody. What does that suite of services look like? Where is it headed?
Yeah, so one of the things that is interesting is, and you know the story of Anchorage, which is we get created because there was a problem in the industry, which is everybody was looking at this cold storage technology, which is the same technology that the pirates used in the 1700s to store their gold coins in treasure chests, bury them in an island, and then have a treasure map to find your gold. And I love using this analogy because it rings really true. Instead of gold coins, you have these smart cards and USB keys and safe deposit boxes in mountains somewhere. But it was effectively using human security and physical security as a proxy for digital security. That's effectively what it was. We knew that private keys were not going to be able to sit on a vault somewhere under a mountain because they were going to get more and more use. Not just fast access to these funds, but elements of decentralized use of smart contracts. And lo and behold, we could not have predicted DeFi, but that's effectively what DeFi is. Active participation with keys that need to be not online, but of easy access, so you can participate, so you can participate in whatever it is that you want to do. Stake, delegate, actually contribute with funds to any of these protocols. All of those are operations that need the highest sensitivity keys that also hold the funds. So that's something that we knew it was going to happen, not necessarily in the form of DeFi, but we knew that keys are only going to get used more and more. So you're absolutely right that we started with a custody technology, really solving that problem for institutions. The interesting thing that happened after, and actually it gives you a really good roadmap of Anchorage's services and platform, is just client need. Clients needed custody, so actual private key use while safe, but they needed regulated custody. And so that's where the regulatory piece came in. And then they had this safety solution that they were comfortable from a regulatory and from a security perspective. And then they wanted to also buy and sell crypto assets through the same entity. I already audited you. I already have the highest trust with you. Why aren't you allowing me to do liquidity and buy and sell directly? Why do I have to go somewhere else? And then they told us that I have billions of dollars of assets under custody with Anchorage. Why can't I have credit? Why can't you extend me credit for all of the crypto that you have on your platform? You already have it there. You have the ability of liquidating it. You have the ability of using it as collateral. Why can't I extend credit? And lo and behold, our lending program starts. Not only that, all of these institutions that wanted to deploy dollars started seeing the opportunities that we could generate. And so that's where, the crypto collateralized dollar loans come from our clients' needs and from obviously the market's needs to access high yield, and recognizing that we already had built the technology for doing all the collateral management. And then obviously staking, all of these assets either require staking or governance. So we had to build these components. And now lately, DeFi. It is very clear that these institutions are interested in maximizing the yield generation and participating directly with the protocols. And I'm sure you see this, but in fact, it's a lot of these entrepreneurs that get VC money and money from institutions are effectively forcing the hand of their investors to be active participants, to actually meet their fiduciary obligations, to stake, to run validators, to run nodes, to actively participate in a protocol, to make their opinions be heard. And the institutions need a way to do that safely, because ultimately those are effectively the same keys. So where was the platform? Where was the way to integrate? And so Anchorage is adding a lot of DeFi assets, a lot of governance, delegation, dashboards, voting, the ability of claiming airdrops, the ability of participating in all these protocols. So that's all that is from day one, customer driven and client driven as a roadmap.
Gotcha. Yeah, the value of having that full stack in one place, and with kind of a single trust underwriting, I think is underweighted. The amount of effort to underwriting a counterparty in this is huge, and so the idea of having those as separate components is, I think, really a huge obstacle. So yeah, like if an institution underwrites a custodian and kind of develop, I mean that's a big process, and so then being able to kind of layer those things on top is like, I think, kind of the only way for institutions to approach it. The idea, like after institutions spend 6 months underwriting a custodian, if they go to their committee and like, oh yeah, we also want to lend these out with another entity, which requires an entirely new underwriting process.
By the way, I'll jump in and point out that in traditional prime brokerage model, you can actually come in at any layer of the stack. You come in at the execution layer, come in at the cap intro layer, you can technically come in at the custody layer, but in crypto, you can't. Lending requires custody for your collateral. Trading requires settlement into a custody system. Staking requires you to do the delegation of the key in a safe custodial environment. And so all of these things actually are layered on the custody platform. You can't actually get away from it the same way that you can in the traditional finance, where you can actually segregate these functions to different market participants. So custody is the technology that everything else is adjacent on. And I think we've seen this. We've seen this in consolidation in the space. Every single lender or exchange or very successful execution platform or what have you, all of them have vertically integrated their actual custody stack. They've acquired, they've tried to build their own. We've seen aggregation because it makes sense. You need to own that.
Mm-hmm. Yeah, that's a great point, and it's so foreign. I feel like both most crypto people and TradFi people don't understand this because prime brokerage is so taken for granted. The whole stock certificate system, where it's kind of like, for anyone not familiar, in traditional finance, basically when you move stuff, it's kind of like what PayPal is to money. It's like a centralized ledger that has all stock certificates, basically. I'm oversimplifying, but there's really no engineering component at all to prime brokerage, and no risk or concern around kind of the counterparty risk, the custody, that side. It's all just happening in a reversible database. And in crypto, as you point out, every element involves custody. And that's such a difference. Like we think of these as kind of analogous business models, and maybe the service is somewhat analogous, but what goes into it is unrelated. We have a few minutes, 2 minutes left to touch on a last topic, crypto estate planning. What role does Anchorage play in this, and how is this going to evolve?
Yeah, so that's a really interesting topic in the sense that actually estate planning, well, maybe let me start a little bit further back. A lot of people come to us and say Anchorage is a centralized company, and Anchorage is actually a platform that does custody. Isn't that against the ethos of Bitcoin of, self-custody and be your own bank? And the answer is no. We want specialization. Because Anchorage exists, we are not forbidding. We're not a gatekeeper that forbids anyone from actually being your own bank too, or competition from competing against Anchorage. But what ends up happening is that, the ethos meets the real world. And what is happening is that if you want to have an estate plan, then you can't be the single holder of these keys. If you want to have an estate plan, then you need the ability of leaving these to your family or to your children. And so that's actually against being just self-custody and you owning your own assets, because you have to leave them to someone. And I would take it one step further. There's a lot of tax efficient ways and ways for you to structure your assets, such as irrecoverable trusts that require you not to have control over your assets. And so it's kind of interesting that, this be your own bank is very much something that we should pursue. The technology should allow it, but there's many, many reasons why retail and institutions are just completely different and distinct. And institutions definitely need partners that are sophisticated, and even large holders that are participating in doing traditional trusts or irrevocable trusts or putting their fund out of their reach. They're doing so with the purpose of tax optimization or whatever it is. And they have to not have control over their assets. So that forces their hand into actually having a third-party safe custodian. So this is kind of interesting because people don't really realize that at the end of the day, everybody needs to pay taxes.
Diogo, we're getting the rope, but thank you so much. That was very educational. Thanks for sharing the wisdom.
Thank you for having me.